Over the 12 months to June 30, our diversified portfolios have again exceeded their investment objectives. For each given portfolio, we have a target return expectation, which is typically a margin above cash, and that reflects the amount of risk that we're allowed to take for each client portfolio. What we've seen over the last 12 months is that client portfolios have roughly doubled that return of that margin over cash. What's pleasing as well is these excess returns that we've been generating for the amount of risk that we take has now occurred on a number of years. And so our clients have been able to achieve returns materially higher than the amount of risk that's been generated in the portfolio on an extended time frame. Well, over the last 12 months, there were really two periods of heightened market volatility. We saw in last October, November, the markets became materially more volatile around concerns on global growth, and in particular the trajectory of US economic growth. Coming into the end of the financial year, we saw heightened volatility really around question marks about Greece's continuation on within the European Union. But in addition to that, an enormous amount of volatility coming out of the Chinese share market, which has been falling precipitously through to the end of the financial year. Despite this volatility, the portfolios continued to generate the excess returns, as I've already said. And really this remains testimony to the diversification and the proper structuring of portfolios away from a single risk factor. Well, in terms of outlook, the first important point that I keep reminding our clients is it's the time frame with which we think about making our investments. And really that's on a 5+ year time frame, because no investor can ever be certain about what the short term is going to bring. That being said, over that time frame, we continue to be comfortable with the equities that we hold in the portfolio. We think they're fully valued, and therefore they should generate returns which are commensurate with the amount of risk that's being taken. What's important there though, and as we've been saying for a while, is that returns that we expect out of equities are going to be lower than what we've been experiencing in recent years. The second point I'd make is there is a number of other things that we expect to generate positively to the portfolio over that time frame. We expect the Australian dollar will continue to depreciate. This is based on interest rate differentials as well as trajectory of relative economies domestically versus offshore, and we continue to be positioned to benefit from that depreciation. Finally, the point I would make is there are a number of things that we expect we will need to contend with over the next 12 months. The US is likely to raise interest rates for the first time, and the market is very aware, not just of the timing around that, but the trajectory of those interest rate rises. Similarly, we're very aware that the issues in Europe surrounding Greece and its ongoing economic viability are all but resolved. What these things point to is the fact that there's always going to be uncertainty, there are always going to be risks that we need to contend with, but what's most important is we're very comfortable with how the portfolios are sitting, the diversification and the range of different elements that we hope to contribute over those investment horizons, and are comfortable that we can continue to meet our clients' investment objectives.